We've talked about cash on cash return, but if you're like me and you're looking at something more as a longer term investment, then you're going to need something a little bit more complex to measure your return. So in this case, we use something called internal rate of return. This takes into account the time value of money. It measures how much money went into the investment and when that money went into the investment, how much money came out of the investment, and finally, when that money came out of the investment. I'm not a math genius, so I can't tell you how to do this on your cell phone calculator. I have an Excel spreadsheet that I go over with my clients that does all the calculations for me. But in short, you're going to need 4 different numbers to calculate this. So first up is present value. To calculate your present value, you're going to need to take your down payment, your closing costs, and any immediate home improvements that you made and show that number as a negative number because those dollars are coming out of your pocket. So next up, you need periodic payment. So in that case, you need to take your gross monthly rent minus your mortgage payment and any monthly expenses. And in the case of any clients that I have that are looking at long-term rentals, we also have to factor in your vacancy percentage. So in other words, what percentage of the time is your property vacant and how many gross rental dollars would that cost you? Now, in the case of a short-term rental, I'm not really worried about full months being empty, so I'm not going to really factor that into this calculation. Next up, you need term. This one's pretty simple. How long are you going to keep the property for? In our case, let's assume 10 years. And finally, you need future value. In other words, how much money am I going to make when I sell the property? In our case of our example, we're talking about 10 years down the road. Now, the first thing that you need to calculate this future value is you need to know the price of the home when you sell it. Now, obviously, this is going to take some guesswork, but you can start by taking the historical appreciation rates of the area that you own the home in to kind of figure out historically what it would mean to sell it, in our case, 10 years down the road. From there, you need to figure out the costs of sale. So for example, you need to figure out how much it's going to cost you to pay a realtor to sell your home, as well as any closing costs that are typically paid by the seller in your area. In our case, let's assume it's going to be 6% of the sales price as the cost of sale. And finally, you'll need to subtract the balance of your mortgage at the time of sale. So I will give you our example based on the historical appreciation rate of Nashville, which is 3.5% per year, as well as our estimated mortgage balance at the end of 10 years. So from here, I'm going to take these 4 items and I'm going to calculate my annual rate of return. Now, this is where my simple phone calculator is going to fail me, so I can't show you exactly how to do the math quickly, so you're just going to have to trust me in my Excel spreadsheet. So all things considered, I usually can't get 23% return on my stock investments, so I am really excited about this rate of return number for our investment property here.